The fundamental human need to acquire goods and services not readily available spurred the earliest forms of trade. This began with the simple barter system. One person would exchange goods they possessed for goods another person had. Imagine a farmer trading surplus grain for a craftsman's tools. This direct exchange was the foundation of commerce. However, this system was inherently inefficient. It relied heavily on a double coincidence of wants. Both parties had to desire what the other offered at the same time and in the right quantities. This made transactions cumbersome and often impossible, severely limiting economic growth and specialization within early communities. The limitations of barter quickly became apparent as societies grew more complex. What if a farmer with grain needed a spear, but the spearmaker didn't need grain? The farmer would have to find someone who had something the spearmaker wanted, and then trade for that item before finally acquiring the spear. This multi-step process was time-consuming and uncertain. Furthermore, issues of divisibility arose. How do you divide a live animal like a cow to trade for smaller items without losing its value? The lack of a common measure of value also meant that every transaction required a new negotiation of relative worth, leading to constant haggling and potential disputes. To overcome these challenges, early societies naturally gravitated towards commodity money. Certain goods, due to their perceived value, durability, or general demand, became accepted mediums of exchange. Examples include cowrie shells in parts of Africa and Asia, salt, from which the word salary derives, cattle and grains. These items were more convenient than pure barter. They offered a degree of standardization. However, commodity money still had its own drawbacks. Cattle were not easily portable for large transactions. Grain could spoil. Shells could vary in quality. The search for a more efficient, durable, and universally accepted medium of exchange continued. This quest for a better system laid the conceptual groundwork for more sophisticated forms of money. Societies began to recognize the importance of items that were not only valuable, but also easily divisible, portable, and durable. Metals, particularly gold and silver, started to gain prominence due to these inherent qualities. Initially, these metals were traded by weight, often in an unrefined or non-standardized form, such as lumps or rings. This was an improvement, but still required weighing and assaying for each transaction. The crucial step towards true currency was the idea of standardizing these metal units, guaranteeing their weight and purity, and marking them as such, the very essence of coinage. The Lydians, an ancient civilization in western Anatolia, modern-day Turkey, are widely credited with a monumental leap in monetary history. Around the 7th century BCE, they began producing the first true coins. These were made from electrum, a naturally occurring alloy of gold and silver. What distinguished these Lydian creations was their standardization. Each coin was stamped with an official mark, often a lion's head, which served as a guarantee of its weight and, by implication, its value. This innovation was revolutionary. It eliminated the need to weigh metal for every transaction, simplifying trade and instilling greater confidence among merchants and consumers alike. The impact of Lydian coinage was profound and far-reaching. Standardized coins dramatically reduced friction in commerce. Transactions became faster and more transparent. Disputes over the value of exchanged goods lessened considerably. This Lydian invention didn't remain a local phenomenon for long. The concept quickly spread to neighboring Greek city-states. These states adopted and adapted the idea, minting their own distinct coins. This proliferation marked the beginning of a more interconnected economic world. An international understanding of currency, based on precious metal content and official minting, started to take root, facilitating trade across different cultures and geographical regions. The Roman Empire, which rose to prominence centuries later, adopted and significantly expanded upon these early monetary systems. The Romans developed a sophisticated and relatively unified currency system that supported their vast empire. Coins like the gold aureus and the silver denarius became widely recognized and accepted across Europe, North Africa, and the Near East. This common currency played a crucial role in fostering economic integration and growth throughout the Roman territories. The extensive network of Roman roads and maritime trade routes further facilitated the circulation of these coins, making commerce more efficient than ever before on such a large scale. However, even the mighty Roman monetary system was not without its vulnerabilities. Over time, particularly during periods of economic stress or excessive military spending, Roman emperors resorted to debasing their coinage. This meant reducing the precious metal content of the coins while maintaining their face value, a practice that inevitably led to inflation. As the purity of coins declined, public trust in the currency eroded. The eventual decline and fall of the Western Roman Empire led to a fragmentation of its monetary system. This had a significant impact on trade and the concept of currency in Europe, ushering in a period where numerous local currencies and bartering re-emerged. Following the collapse of the Roman Empire, Europe experienced a period of monetary fragmentation. The unified Roman currency system gave way to a plethora of local coins issued by feudal lords, kings, and even cities. Each region often had its own distinct coins, varying in weight, purity, and value. This diversity created significant challenges for merchants who traveled between different territories. They constantly faced the risk of being cheated or miscalculating exchange rates. Carrying large sums of disparate coins was also dangerous due to bandits and insecure travel routes. This complex and risky environment created a pressing need for specialized financial intermediaries. In response to these challenges, the figure of the medieval money changer emerged. These individuals, often found at bustling trade fairs, port cities and market towns, possessed the expertise to evaluate the various types of coins in circulation. They could determine the gold or silver content of different currencies and facilitate their exchange at agreed-upon rates. Money changers set up tables or banks from which the word bank originates to conduct their business. Beyond simple exchange, they also began to offer rudimentary banking services, such as safeguarding deposits for merchants, which was a crucial service in an era of widespread insecurity for travelers carrying wealth. A further significant innovation during the medieval period, particularly driven by the burgeoning trade networks of Italian city-states like Venice, Genoa and Florence, was the bill of exchange. This financial instrument was a brilliant solution to the perils and inconveniences of transporting physical specie over long distances. A merchant could deposit a sum of money with a trusted money changer or merchant banker in one city. In return, they would receive a written order, the bill of exchange, instructing an agent or correspondent of the banker in another city to pay a specified sum to the merchant or their designated representative upon presentation of the bill. The bill of exchange revolutionized international trade. It drastically reduced the risk of robbery, as merchants no longer needed to carry large quantities of gold and silver coins on treacherous journeys. It also facilitated larger and more complex transactions, as credit could be extended and payments settled across significant geographical distances without the physical movement of bullion for each deal. This system fostered greater trust and interconnectedness among trading centers. Furthermore, bills of exchange laid the foundational principles for more sophisticated credit instruments and the development of international banking networks, profoundly shaping the future of finance and commerce in the centuries that followed. The centuries following the medieval period saw fluctuating currency values and a desire for greater monetary stability, especially as international trade expanded. The intrinsic appeal of gold, due to its rarity, durability and universal recognition as a store of value, made it a natural candidate for a monetary anchor. The idea was to create a system where currencies were backed by and convertible into a fixed amount of gold. This concept gradually took shape, culminating in what is known as the classical gold standard, which gained widespread adoption among major trading nations primarily in the late 19th and early 20th centuries, with Great Britain playing a leading role in its establishment. Under the classical gold standard, participating countries defined their currency's unit of account in terms of a specific weight of gold. For instance, the British pound sterling or the US dollar would be worth a certain quantity of gold. Central banks or national treasuries were committed to buying or selling gold at this officially fixed price to anyone who wished to do so. This commitment effectively linked the domestic money supply to the country's gold reserves. If a country's gold reserves increased, its money supply could expand and vice versa. This system aimed to create fixed exchange rates between the currencies of participating countries, as each currency had a defined gold value. The gold standard was perceived to offer several significant benefits. Chief among these was price stability. By tying the money supply to the physical quantity of gold, it was believed that governments would be prevented from excessively printing money and causing inflation. The system also provided stable exchange rates between member countries, which greatly facilitated international trade and investment by reducing currency risk. Furthermore, it had a theoretical self-correcting mechanism for trade imbalances known as Hume's price-specie flow. A country with a trade deficit would see gold flow out, contracting its money supply, lowering prices, and making its exports more competitive, thus correcting the deficit. Despite its advantages, the gold standard also had inherent limitations and faced severe pressures. A major constraint was that it limited a government's ability to conduct independent monetary policy. For example, during an economic recession, a government couldn't easily increase the money supply to stimulate the economy if its gold reserves were insufficient. The system demanded fiscal discipline. The immense financial strains of World War I proved to be a critical blow. Belligerent nations suspended gold convertibility to finance war efforts through printing money. While there were attempts to restore it in the 1920s, the system lacked its pre-war stability and eventually crumbled during the Great Depression of the 1930s. Section 5. Turbulence and Transition. The interwar period and Bretton Woods. The period between World War I and World War II, known as the interwar period, was marked by significant economic turbulence and monetary instability. The classical gold standard had effectively collapsed due to the war. Many countries struggled with war debts and reparations. There were attempts to return to a form of gold standard in the 1920s, but these were often poorly coordinated and unsustainable. Some countries overvalued their currencies, others undervalued them. This led to competitive devaluations, where nations deliberately lowered their currency values to boost exports at the expense of other countries' so-called beggar-thy-neighbour policies. This economic nationalism exacerbated the Great Depression and severely hampered international trade. Recognizing that the chaotic monetary conditions of the interwar period had contributed to economic hardship and political instability, the Allied nations began planning for a new international monetary order even before World War II ended. The goal was to create a system that would foster global economic cooperation, promote exchange rate stability, and prevent the destructive currency policies of the past. In July 1944, delegates from 44 Allied nations convened at Bretton Woods, New Hampshire, for the United Nations Monetary and Financial Conference. Key figures like John Maynard Keynes from the UK and Harry Dexter White from the US played influential roles in shaping the discussions and the eventual agreement. The Bretton Woods Agreement established a new international monetary system. It was an adjustable peg system, often called a gold exchange standard. The US dollar was pegged to gold at a fixed rate of $35 per ounce, and the United States committed to converting dollars into gold at this price for foreign central banks. Other major currencies were then pegged to the US dollar within a narrow band of fluctuation, typically plus or minus 1%. Countries were expected to maintain these parities, though they could adjust them in cases of fundamental disequilibrium with the approval of the newly created International Monetary Fund, or IMF. The World Bank, then the International Bank for Reconstruction and Development, was also established to provide financial assistance for post-war reconstruction and development. Initially, the Bretton Woods system was quite successful. It provided a framework of stable exchange rates that helped facilitate the remarkable recovery of the global economy after World War II. International trade and investment flourished under this system. The US dollar became the world's dominant reserve currency, widely used in international transactions. However, the system contained inherent tensions. As the economies of Europe and Japan recovered and grew, the United States began running persistent balance of payments deficits. This meant more and more US dollars were held abroad. The increasing volume of foreign-held dollars eventually exceeded US gold reserves, casting doubt on the US ability to honor its commitment to convert dollars to gold at $35 an ounce. Section 6. The Nixon Shock, the end of Bretton Woods and rise of floating rates. By the late 1960s and early 1970s, the Bretton Woods system faced mounting pressures. The United States was financing both the costly Vietnam War and significant domestic social programs known as the Great Society. This expansionary fiscal policy, without corresponding tax increases, led to inflation in the US and a weakening of the dollar's perceived value relative to gold and other currencies. Foreign central banks, particularly in Europe, began to accumulate vast quantities of US dollars. They grew increasingly concerned about the US's dwindling gold reserves and its capacity to maintain the dollar's convertibility into gold at the fixed rate of $35 per ounce. Speculative attacks against the dollar became more frequent. The breaking point arrived on August 15, 1971. In a move that became known as the Nixon Shock, US President Richard Nixon unilaterally announced a series of economic measures. The most significant of these was the suspension of the direct convertibility of the United States dollar into gold. This action effectively severed the last formal link between the world's major currencies and gold. Nixon also imposed a temporary 10% surcharge on imports to encourage other countries to revalue their currencies against the dollar. This decision marked the definitive end of the Bretton Woods system, which had governed international finance for over a quarter of a century, plunging global currency markets into a period of uncertainty. In the immediate aftermath of the Nixon shock, there were attempts to salvage a system of fixed exchange rates. The Smithsonian Agreement in December 1971 established a new set of par values with wider bands of fluctuation, and the dollar was devalued against gold. However, these efforts proved short-lived. Market pressures continued to build, and by March 1973, the major industrialized nations abandoned the fixed pegs and allowed their currencies to float. This meant that exchange rates would no longer be determined by government decree, but by the forces of supply and demand in the foreign exchange market. This transition marked the birth of the modern Forex market as we understand it today, characterized by continuously fluctuating currency values. The shift to floating exchange rates had profound implications. On one hand, it introduced significantly greater exchange rate volatility, creating new risks for businesses involved in international trade and investment. On the other hand, it granted national governments greater autonomy over their domestic monetary policies. They were no longer constrained by the need to maintain a fixed exchange rate. The new environment spurred the development of financial instruments such as currency futures and options, designed to help manage this increased currency risk. For speculators and financial institutions, the era of floating rates opened up new opportunities for profiting from currency movements, leading to a rapid expansion in the volume and complexity of Forex trading. Section 7. The Digital Revolution. Emergence of Retail Forex Trading. Before the widespread adoption of the Internet, the foreign exchange market was an exclusive domain. It was primarily an interbank market, meaning that transactions were conducted between large commercial banks and financial institutions. Multinational corporations participated to hedge their currency exposures arising from international business, and some very wealthy individuals might have had access through private banking channels. However, for the average individual or small investor, direct participation was virtually impossible. Transaction costs were prohibitively high, and access to real-time pricing information and execution platforms was limited to these major players. The market was opaque and inaccessible to the wider public. The advent of the internet and rapid advancements in computing technology during the late 1990s and early 2000s acted as a powerful catalyst for change. These technological breakthroughs led to the development of online trading platforms. These platforms began to democratize access to various financial markets, including the foreign exchange market. Suddenly, the barriers to entry started to crumble. Retail brokers emerged, specifically catering to individual traders. They offered the ability to trade currencies from a personal computer, bringing the world's largest financial market to the fingertips of a much broader audience than ever before. This was a revolutionary shift in the landscape of Forex trading. Early retail Forex trading platforms offered a suite of tools that were previously unavailable to individual traders. These included real-time streaming price quotes for various currency pairs, sophisticated charting packages with technical indicators, and, crucially, the ability to execute trades with relatively small amounts of capital. This was made possible through the provision of leverage, where brokers allowed traders to control a large position with a smaller initial deposit. While leverage magnifies potential profits, it also significantly amplifies potential losses. The combination of accessibility, advanced tools, and leverage proved to be a potent mix, attracting a new wave of participants to the currency markets. The growth of retail Forex trading was explosive. The allure of a market that operates 24 hours a day, 5 days a week, its immense liquidity, and the perceived potential for substantial profits drew in many aspiring traders from around the globe. However, this new accessibility also came with significant risks. Many novice traders underestimated the complexities of currency trading and the dangers of high leverage, leading to substantial losses for some. Over time, regulatory bodies in various jurisdictions began to pay closer attention to the retail Forex industry, implementing rules to protect consumers, ensure broker transparency, and maintain market integrity, leading to an evolving regulatory landscape for this segment of the market. Section 8. Modern Forex AI, Algorithms, and the Crypto Influence. The modern foreign exchange market is characterized by an ever-increasing level of sophistication, largely driven by technological advancements. Algorithmic trading, where computer programs execute trades based on preset instructions, has become a dominant force, particularly among institutional players like banks and hedge funds. High-frequency trading, a subset of algorithmic trading, involves executing a vast number of orders at extremely high speeds, often in microseconds. These algorithms can analyze market data, identify trading opportunities, and execute trades far faster than any human possibly could, contributing significantly to market liquidity, but also at times to short-term volatility. Artificial intelligence and machine learning are increasingly being integrated into Forex trading strategies and market analysis. AI algorithms can be trained on vast data sets of historical price movements, economic news, and even social media sentiment to identify complex patterns and predict potential future currency movements with greater accuracy than traditional models. These technologies are also employed for sophisticated risk management, optimizing trade execution, and developing adaptive trading systems that can learn and adjust to changing market conditions. The ongoing research and development in AI and ML promise to further transform how market participants approach Forex trading in the coming years. The emergence of cryptocurrencies, starting with Bitcoin in 2009, has introduced a new, albeit volatile, asset class that interacts with the traditional financial world, including Forex. While cryptocurrencies operate on decentralized blockchain technology and are distinct from fiat currencies issued by central banks, the trading of cryptocurrencies has borrowed many concepts and tools from the Forex market. Traders use technical analysis, chart patterns, and trade currency-like pairs, such as BTC-USD. Many Forex brokers now offer contracts for difference on popular cryptocurrencies, allowing traders to speculate on their price movements without owning the underlying asset. The debate continues regarding whether cryptocurrencies will eventually become a mainstream part of the Forex landscape or remain a niche, albeit influential, market. The evolution of trading technology shows no signs of slowing down. Mobile trading apps have made it possible to monitor markets and execute trades from virtually anywhere, further enhancing accessibility. Social trading platforms allow less experienced traders to follow and copy the trades of more successful ones, though this practice also carries its own risks. The relentless pursuit of faster execution speed, more comprehensive data analytics, and more robust trading infrastructure continue to drive innovation. Navigating this dynamic environment requires traders and institutions to constantly adapt, stay informed about new technologies, and be aware of the evolving regulatory frameworks designed to govern these advanced trading methodologies. Section 9, the Forex market today: scale, participants, and key currencies. The contemporary foreign exchange market is, by a significant margin, the largest and most liquid financial market in the world. Its sheer scale is astounding. According to the Bank for International Settlements Triennial Central Bank Survey, global Forex market turnover reached an average of $7.5 trillion per day in April 2022. This colossal volume dwarfs that of global stock markets combined. The Forex market is decentralized, meaning it has no central physical location or exchange. Instead, trading occurs electronically over the counter between a global network of banks, corporations, and individuals operating 24 hours a day, 5 days a week, across different time zones. A diverse array of participants drives activity in the Forex market. At the top tier are the major commercial and investment banks, which form the interbank market. They trade currencies for their own accounts and on behalf of large clients. Central banks also participate, managing their country's foreign exchange reserves, influencing monetary policy, or intervening to stabilize their currency. Multinational corporations engage in Forex transactions to hedge against currency risk arising from international trade and investment. Investment management firms, including pension funds and hedge funds, trade currencies for speculative purposes or as part of broader investment strategies. Finally, the retail segment, consisting of individual traders, has grown significantly in recent decades. A handful of major currencies dominate trading activity in the Forex market. The US dollar reigns supreme, acting as the world's primary reserve currency and being on one side of approximately 88% of all Forex trades, according to the 2022 BIS survey. Its dominance stems from the size and strength of the US economy, the depth of its financial markets, and its historical role in international trade and finance. Other heavily traded currencies include the euro, which is the second most traded, followed by the Japanese yen, the British pound, the Australian dollar, the Canadian dollar, and the Swiss franc. These majors are often traded against each other or against the US dollar. In conclusion, the foreign exchange market plays an indispensable role in the modern global economy. It facilitates international trade and investment by allowing businesses to convert currencies. It is crucial for the price discovery of exchange rates, reflecting the relative economic health and prospects of different countries. Furthermore, it provides mechanisms for managing and hedging currency risk. From its ancient origins in barter to today's technologically advanced multi-trillion-dollar marketplace, Forex has continuously evolved. As global interconnectedness deepens and financial innovation persists, the Forex market will undoubtedly continue its dynamic transformation, remaining a cornerstone of international finance for the foreseeable future.